let's be honest for a second. When you hear the word investing, what comes to mind? Do you see a guy in a suit on Wall Street shouting into a phone? Do you see a complex spreadsheet with Greek letters that only a PhD can understand? Or maybe you just see a number that feels completely out of reach. You think, I can't invest because I don't have enough money. That is the single biggest lie holding your financial future hostage. Today, on Fiscal Beacon, we are going to dismantle that myth. We are going to show you exactly how to start investing with just $100 a month. By the end of this video, you will know where to open an account, what to buy, and why starting now is more important than starting with a bigger amount later. Let's dive in. First, let's address the elephant in the room. Why does $100 feel like so little? In the grand scheme of a home price or a car purchase, $100 is just a fraction. But in the world of long-term wealth building, $100 is a seed. And like any seed, it doesn't matter how small it is when you plant it. It matters that you planted it. Many people wait until they have extra money to start investing. They wait for a raise, a bonus, or to pay off every single debt. But here is the counterintuitive truth. Waiting is the most expensive thing you can do. The cost of waiting isn't just the money you didn't invest, it's the time your money didn't have to grow. Let's look at two hypothetical friends, Alice and Bob. Alice starts investing $100 a month at age 25. Bob waits until he feels ready and starts at age 35. Both earn an average annual return of 7%, which is a reasonable historical average for the stock market. At age 65, Alice will have over $260,000. Bob, who invested the exact same amount every month but just 10 years later, will have only about $120,000. That 10-year delay cost Bob over $140,000, not because he made bad decisions, but because he waited. This brings us to the most powerful force in finance, a force that Albert Einstein reportedly called the eighth wonder of the world. It's called compound interest. So what is compound interest, really? It's not just interest on your money, it's interest on your interest. Imagine you have a snowball at the top of a hill. You push it and it starts rolling. At first, it's small, but as it rolls, it picks up more snow. That new snow also has surface area, so it picks up even more snow. Your initial investment is the first push. The returns your money earns are the snow. And over time, the snowball gets so big that it picks up snow on its own, without you having to push it as hard. Let's put numbers to this. If you invest $100 a month for 30 years at a 7% return, you will have contributed a total of $36,000 of your own hard-earned cash. But your account balance won't be $36,000. It will be over $120,000. That means $84,000 of that money came from the market growing, not from your paycheck. That is the power of letting time work for you. And here is the best part. You don't need a huge lump sum to start this process. You just need consistency. Now let's talk about where this $100 actually goes. You have three main buckets to consider. First, the emergency fund. Before you invest a single dollar, ensure you have 3 to 6 months of living expenses saved in a high-yield savings account. This is your financial seatbelt. If you lose your job or your car breaks down, you don't want to be forced to sell your investments at a bad time. Second, employer-sponsored retirement plans. If your employer offers a 401(k) with a match, contribute enough to get the full match. This is literally free money. If your employer matches 50% of your contributions up to 6% of your salary, you are instantly earning a 50% return on your investment. No other investment offers that. Third, individual retirement accounts, IRAs. If you don't have a 401(k) or you've maxed out your match, look into a Roth IRA. With a Roth IRA, you contribute after-tax dollars, but your money grows tax-free, and you can withdraw it tax-free in retirement. For someone investing just $100 a month, a Roth IRA is often the perfect vehicle because it's easy to open, low cost, and offers incredible tax advantages. Okay, so you have the account. You have the $100. What do you actually buy? This is where many beginners get paralyzed. They think they need to pick the next Apple or Tesla, but trying to pick individual stocks is like trying to win a lottery. It's risky, it's stressful, and it rarely works for the average person. Instead, we recommend a strategy called diversification through index funds or ETFs, exchange-traded funds. Think of an ETF like a fruit basket. Instead of buying just one apple, one stock, and hoping it's sweet, you buy a basket that contains a little bit of apple, orange, banana, and grape. If the apple goes bad, you still have the rest of the fruit. The most popular choice for beginners is a total stock market ETF, like VTI, or an S&P 500 ETF, like VOO or IVV. These funds track the entire U.S. stock market or the 500 largest companies in the U.S. By buying one share of these funds, you are instantly owning a tiny piece of hundreds of companies. If the economy grows, your money grows. It's simple, it's boring, and it works. Let's do a quick reality check on fees. In the past, buying stocks meant paying $10 or $20 per trade in commissions. Those days are mostly gone. Most modern brokerages like Fidelity, Vanguard, Charles Schwab, and E*Trade offer commission-free trading for stocks and ETFs. However, you need to watch out for the expense ratio. This is the annual fee the fund charges to manage your money. For a total market index fund, this fee is often less than 0.1%. On a $100 investment, that's a fraction of a penny. But over decades, high fees can eat away at your returns. Always look for funds with low expense ratios. You are looking for efficiency, not complexity. Now that we know what to buy and where to put it, we need to talk about the hardest part: discipline. It is easy to invest $100 when the market is going up. It is hard to invest $100 when the news is screaming that the market has crashed 20%. This is where automation is your best friend. Set up an automatic transfer from your checking account to your investment account for the day after you get paid. Treat that $100 like a bill you have to pay. You wouldn't skip your electric bill because you're having a tough week, right? So don't skip your future self. By automating it, you remove the emotion. You don't have to decide whether to invest that month. You already did. You decided months ago. This strategy is called dollar cost averaging. It means you buy more shares when prices are low and fewer shares when prices are high, averaging out your cost over time. It smooths out the bumps in the road. Let's look at a 10-year projection for this automated $100 a month. Again, assuming a 7% annual return. In year 1, you'll have about $1,200. In year 5, you'll have around $7,000. By year 10, you'll have roughly $17,000. Now, $17,000 might not sound like a fortune, but remember, this is just the foundation. If you increase that contribution by just 3% every year, say, when you get a raise, that $100 becomes $103, then $106, and so on. That small increase compounds just like your investments. Over 30 years, that initial $100 a month can grow into a sum that changes your life. The key takeaway here is that investing is not a sprint, it's a marathon. It's not about getting rich quick. It's about getting rich slow but sure. It's about building a habit that sticks. So here is your action plan for this week. Step 1, open an account. Whether it's a Roth IRA or a taxable brokerage account, just open it. Step 2, set up the automation. Link your bank account and schedule the $100 transfer. Step 3, buy the fund. Purchase a broad market index ETF. Step 4, walk away. Do not check the app every day. Do not panic when the news is bad. Trust the process. I want to be clear, I am an educator, not your financial advisor. This information is for educational purposes only. Please consider consulting a qualified financial advisor to tailor a strategy to your specific situation, risk tolerance, and goals. If you found this video helpful, please hit that like button. It really helps the channel. And if you're new here, subscribe to Fiscal Beacon. We break down complex money topics into simple, actionable steps so you can take control of your financial future. In our next video, we're going to talk about how to pay off high-interest debt while still saving for the future. It's a tricky balance, but we have a step-by-step system for it. You won't want to miss it. Thanks for watching, and remember,